Is the market going where everybody anticipated? Stay tuned. Welcome to this week's edition of NoteSchool TV, where every Wednesday at 11:05 Central Time, we go live. And, well, this week is our monthly update. We are excited to bring this to you guys. We love doing this every month, and we like keeping you up to date on, really, where the market's going. Right? So before we get started with that, a couple of things here. Number one, make sure and hit that like button. Boom. Yep. Like the episode. Make sure and continue to forward this and share this with your friends, right? We really appreciate you doing that. And number two, make sure and hit that bell notification so that you will know when we're about to go live every week. And if you have not subscribed to the NoteSchool TV channel, go ahead and do that as well. We need you on there, and we need you staying plugged in with us. So also, if you would, if you have any questions about what we do at NoteSchool, want to talk with us a bit, check us out, go to noteschool.com/TV. Again, noteschool.com/TV. So we have a lot to go through today. There is a lot happening in the market, and it is, well, it's all over the place. So let me bring on NoteSchool's founder, all around good guy, our chief visionary officer, Mr. Eddie Speed.
Good morning.
Good morning. How are you?
I'm good. It is the end of July, and we're in Texas, Joe. So, we have a little bit of heat here, but that's what we're supposed to have in July.
Yes.
And there's a little, as you said, a little heat in the market. And I'm a little bit in limbo this month, Joe. As we talk through this, I'm not ready to call the ball yet on a couple of things, but I would say we're pretty leaned up and paying attention about what the market's telling us.
It's every month, it seems, as we're preparing to do this. I mean, we could literally take 3 or 4 hours going. There is that much information out there, and some of it's conflicting, right? I mean, who knows? And we just try to take the best of what it is and our best sources and bring what that looks like to you guys.
Yeah.
Yeah.
I would say more this month is about the residential story, less about the commercial. Commercial is what's happening is going to happen. Listen, you can go back and watch NoteSchool TV 2 years ago, and we've been calling this ball, and now all of a sudden it's kind of like the market's finally hitting, and so we'll vacillate from month to month as to what we focus on. I think this month there's some trend lines in the residential space, and we're seeing it overlap into seller financing, and so I think it's worth. Your research led us a little more in that direction this month. So let's bust it out, Joe, and talk about it.
Let's talk about the housing market first, Eddie. So Business Insider put together some predictions on, for the rest of this year. This is the end of the 7th month. We've got 5 more months to go. And so, first of all, it's home price prediction.
What is the date on these predictions?
It's by the end of 2024.
No, but when did they make them?
Oh, this was a few weeks ago. Oh, no, last week.
See, I don't know that I'm seeing this.
Yeah.
I know that's what they're just not giving up on their predictions.
Yeah.
Right? They made these predictions at the beginning of the year, and they haven't faltered in the predictions. And I'm looking at data going, listen, I'm not being disrespectful because I think they have good information and some really sharp people, but there's some trend lines that doesn't look right to me.
Well, if you look at this, and then we've got a slide coming up here in just a second about inventories. Inventory is going up in nearly, all but 2 states.
All right. So everybody said Fannie, mortgage bankers, NAR, they're all saying it's all good. It's a green light.
It's a green light.
All right. Let's keep
NAR
going.
is the lesser of two evils. Yeah. So yeah.
You know, I got to give NAR credit. They're not usually the ones stretched out making the highest predictions.
They're not.
You would think that they are, because they're selling enthusiasm for people to, list their house and move forward and stuff. But they're usually tailing a little bit, and
they are,
and they're tailing by half, more than half.
More than
half.
half.
The predictions are. So let's keep going, and we'll build a story. We'll let you draw your own conclusions.
Let's do it. So there is a lot of words on this, but I really, this goes to the home, or to the sentiment in the market, right? And with this whole lock-in effect, and according to this is Bankrate and Mortgage Point reported it, but more than half of homeowners, 52%, said they would need the rates to drop lower than 6% to feel comfortable buying a house this year. And just 2% of homeowners said that they would be comfortable purchasing a house if it were 6% or higher. Just 2%.
Well, where's the other 46?
I know, right?
They must not have voted.
Well, homeowners don't feel motivated to sell either, Eddie. A mere 5% of homeowners say they would be comfortable selling their home with mortgage rates at 6% or higher. And then 47% say that mortgage rates need to be below 5% for them to feel comfortable buying a home this year. Fully 38% say rates would need to go below 4%. I can say one thing to that, and that would be good luck.
That ain't gonna happen.
Good luck, right? We know that's not going to happen.
87% of the people have an opinion, but they didn't share it.
Yeah.
Right. Well, it's interesting that we've kind of drawn this line in the sand on rates. And of course, I think they're positioning questions, and people they're not filling in the blanks. They're just answering a question where somebody's already filled in the blank, so to speak. Right.
Well, and there's still that thing out there that everybody wants the rates to go to 2 or 3 or 4% again. And anyway, it ain't happening.
Joe, I scraped this one.
Yep, you did. Yep, from Resi Club.
And I just thought, that was so worth the conversation, right? Joe, explain this. That yellow's not going to show up. You're going to have to use a red pen, but I can tell you that's an ugly number right there.
So what that really means, guys, is that inventory in Florida is 71% more between June of 23 and June of 24. 71% up.
All right. So I just looked at the highest population states. Okay. So, Florida, California, Texas, right. Washington, D.C., and these are all Arizona. Look at Arizona, up 54%.
Yeah.
Right. So this is
Georgia.
I saw that 53%. In fact, I studied this chart again this morning, just thinking about what does this mean? It's a trend line. It doesn't mean the story's over yet, but it does show us a trend line. Inventory is way, way up from where we were a year ago, and people are somewhat acting like it's all the same story.
Yeah.
This is leading us potentially to a different conclusion. Now, let me be careful. I'm not trying to pull out the black curtain yet, right? But I'm saying to you, I'm going to be honest with you. South Dakota's inventory is less. Okay. Now, Joe, what kind of impact does that make on a national market?
It doesn't, not even a bleep, really.
Now, Nevada is a little bit of a different story. That was interesting.
Yep.
But let me tell you something. These states that have been so strong and that people have paid so much attention to their trends, you know, some of which Joe has circled there. It is, you know, in the Carolinas, look at that. They're almost, they're right hovering at right less than 50%.
Yep.
So pay attention to the fact that we have definitely a trend line, Joe, that's going crazy on you, isn't it?
Yes, it is. Okay, go ahead.
All right. So understand that this is a trend line of increase in inventory. And what people have always said is all these things can't happen because there's no inventory. Well, that's not trending to be the case. So pay attention. All right, let's move on.
Well, yeah, we've got more inventory than we've had. Yes. So cash crash, right? All cash offers.
A lot more inventory.
Yeah, a lot more inventory. So investor cash purchases dropped 64% in the first part of quarter of 2024. And this was, you know, from 2021 when almost 70% of investors paid in cash to win the bidding wars. And then I thought this was told a lot too. This is the lowest share of cash buyers since the crash of 2008.
Joe, let me tell you the trend line here. The trend line here is they're not buying rentals because they ain't making any money, and that's why they're coming to Note School, and that's just the truth. Notes aren't near as big as people buying rentals, but the trend line in people buying rentals and paying cash is dropping like a rock, and the reason is because they pull out their financial modeling and their Excel spreadsheets, and they go, "Oh my God, we're not making any money.
It doesn't match."
Expenses went up by 60% and rents went up by 20%. Guess what? A rental is making less money than it was making in 2019. That's a general statement. That is a general statement. But if you want to see the result of that, look at how people are acting with their money.
That's it.
All right.
Just not doing it.
Trend line to pay attention to. We are seeing it because they're showing up at Note School in Groves. And this is why.
That's it. So
Eddie, we're trending wrong at the wrong time of the year.
That's right.
We should be going up.
Yep, we should be. So here we are right here. I was trying to get a red pen there. And but you know, and that's right. I mean, who do we trust? Do we trust, you know, the St. Louis Fed? Do we trust somebody else? But yeah. So we're at Q4 where the average, or Q2 of 24 at 412,300, and that ticked down just a bit here, right? It had ticked up in here up to about, I think it was about $435,000, Eddie.
Yeah.
So that is a trend down.
So it's not a 10% trend down, but it's not trending in the right direction.
No, not at all.
All right.
And then we've got the U.S. existing home sales, and thought this was, you know, we're right here, and that's trending down as well.
In the wrong month.
Summer months, June especially.
Joe, look at May, June, and July. Look at almost every other line other than the purple line.
Right.
Look at the trend line. It trends up. Right? Yeah. This is the time of the year that they're almost all are trending up. There may be one or two that trended down.
Yeah.
We were trending up, which you're looking at the purple line, which is this year. Right. We were trending up, but now all of a sudden we already started trending down in June.
There is a slide. Yes.
That's the wrong time to say that that's happening.
People want to get into a new house before the school year starts and all of that. And so this is, that's it.
Listen, I want to be careful about this. We're not calling the ball yet, right? This could be, there's some things about inventory, and there's some things about sales, and there's some things about what stuff is listed for that tell us that the market may have hit a wall, right? But Joe, the answer is it's just too early to call it yet.
It is too early.
And by the way, Big Brother, all these, Fannie and mortgage bankers and stuff, they call this at the beginning of the year, and they had a chance to recall it middle of the year, and they haven't recalled the ball.
No.
So we're just trying to pay attention to the fact that we're seeing a little odd behavior in the market that is worth being aware of.
There's a lot going on this fall.
Seller financing is up. I can tell you that.
Yeah.
Seller financing is up.
Yes.
So people are selling more property with seller financing than there were. And that is because I think, Joe, it's combativeness against conventional lending.
It is. And what this all does is it just that even though we do have we'll look at the mortgage credit availability index here, it did tick up just a bit, but again, there's a huge part of the market that they're just done with the whole game the banks and the lenders are playing in the GSEs. So yeah. Let's talk about banks. So this is our source that I used for so long. They haven't updated their rate since June. Don't know what happened to them, but pull this, and this is the current rates. And Eddie, this assumes an 800 plus credit score, 20% down, less than 35% debt to income ratio. And there you go.
This is the riskiest free loan out there.
Yep.
Yeah.
That's it. So, is that going to change? Like I said, we'll see what happens here, but that is the what it looks like. And here we go with the mortgage credit availability index. And so it's at an even 95. Eddie, last month it was at a 93.2 last month. So,
well, here's the bigger picture, Joe. It was at 185 before the virus started. So let's just say that about 50% of the people that could get a mortgage before the virus can get a mortgage today.
Yeah, ride that pony down and then up a little bit and then all the way down. Yeah, that's still half.
And so you can call it whatever you want to, but this is why people are seller financing properties is so many people have been left behind.
That's it.
Right.
That's it. And wanting to buy.
Yeah.
So here is, this is the 30-year, fixed rate. And Eddie, I wanted to show this again. We haven't looked at this in a while. And the only reason I wanted to bring this up is for everybody, as we were talking about at the first of the call, well, they want it to go down to below 4. And, that was just there was a couple of times here when we were trying to recover from the Great Recession. And then we were in the middle of a pandemic over here.
Yeah.
But that's, and again, this isn't the APR. This is just the rate. We showed the APR there on the last slide, but that's, and then you remember this very well, right?
Yeah. So if we're just saying what's normal, rates above 5%, really above 6% are normal.
Somewhere in here.
Right. And so you kind of showing 6%, and so you're looking at it since 1980 or before then. But that yellow line that Joe drew all the way across, that's about 6%, and that's normal.
Yep.
Right. And people are making all these things. Well, if rates are below 6, then I did it. Like, okay. So the market is got to adjust to what the rates will be. And yes, I think there's an argument that we'll probably there's a fairly compelling argument that we're going to see a slide back in rates towards the end of the year, but and we'll see what the Fed does. What the Fed does tomorrow, Joe, and we'll discuss it, but it's probably not going to make any difference whatsoever. The market already thinks the Fed's going to drop the rates a little bit. They just don't know if it's in August or September.
Yeah. Well, it's like I said, it's going to be an interesting fall, Eddie. And by the way, just seeing here, looking at this, when you draw this yellow line, when I drew this, they've been above that line more than they've been below the line.
The average rate's about 7.5.
Yeah. Yep.
All right.
So here is the other part of that 2024. This is the rates as they go up for 30-year fix. So Fannie thinks they're going to end the year about 7%. MBA, Mortgage Bankers, says about 6.5%. And NAR, they're saying it will peak here and then end up somewhere around 6.5% by the last quarter of the year.
Right. By the way, that's not the APR.
No, that is the rate.
So so real interest rates are going to be almost 1% higher than that. Just so you know, like that's not the APR.
Yeah, and if the Fed drops the federal funds rate from 5.25 down to 5, that doesn't mean that's where the rates are. There's always that 2+ spread in there. So there you go. Yeah.
Mortgage rates are 10-year bond rates, T-bill rates are predominantly the indicator. Right. When we saw rates shooting up, we didn't see mortgage rates shoot up at the same rate. They eventually caught. They did. But they didn't move at the same rate the other, and don't expect them to move necessarily at the same rate the other. The interesting thing about it is, Joe, is that funds are sitting on a lot of cash. Loans are probably trading it below where the market says they should trade, but quite honestly, and that's because they're just cash position in the market.
That's it.
All right.
So I thought this was interesting as far as, what we've seen credit card debt, right, go up, almost $2 trillion. And so Bloomberg reports that Citi, if you have a Citi credit card and you're not using it, they're just closing it, basically. And you can see how their losses have gone up from
that yellow here
about 2%. Up to, a little over 6% over here. So, and it is not just Citi, right? It is Citi, it is Wells Fargo, it's JP Morgan Chase, it's Bank of America, it's all of those. And they're saying their credit card charge-off business soar more than 60% in the second quarter compared to a year ago. That's a lot.
We saw it trending. We saw delinquency trending. We saw the use of credit cards. People seemingly, not everybody, of course, but there was this huge trend of people after they stopped getting a government check, Joe, they didn't stop buying on Amazon. They just used a credit card to buy.
And Eddie, one of the things, and I'll get on my soapbox for about 4 seconds here, they're sending out the 0% for 12 months or 18 months. And you got 0%, but if you don't pay them off, then it goes up to as high as 36%.
Yeah.
That's a lot.
Well, Joe, credit card's not real money.
No, it's monopoly money, right? All right. So banks are in limbo without crucial lifeline. Next cracks, right? So, this was done by CNBC and Gabriel Cortez, and there is literally, but in the Claros Group, more than 280 U.S. banks. Look at this. That's almost $1 trillion. That's closer to $1 trillion than further away in assets. And here's 16 banks with 412.7 billion in total assets that are challenged, and then we've got 265 with 363 billion in total assets, and then one which would be, and this one bank that's considered a small to medium sized bank at 116.3 billion total assets. So there is some challenges there.
Well, I can tell you this, that most of the gigantic increase in the amount of loans that we're seeing, performing notes that we're seeing for sale, and it has been a significant increase. I'm going to call it 5 times more loans than we were bidding on this time last year. Literally, most of it, the story goes back to the banks.
Yeah, it does.
They were borrowing money at the banks, and now all of a sudden the banks have tightened up, and it's cut off the money supply. So we're seeing it from a positive because we're really, to some degree, kind of competing with the banks.
We are.
If the banks are lending cheap and plentiful money, they don't need to come see us to sell their notes. If the banks cut them off and say, hey, we're not playing anymore and you need to go liquidate some of your inventory and your notes, that's when we're seeing it. And that is definitely the pattern.
Definitely. Well, let's talk about commercial multifamily. So you brought this one in. U.S. apartment transactions slump lowest level since the pandemic.
Well, you can say what you want to about the trend line, but the answer is that what we've been saying about apartments, and we called the ball back in late 22.
Yep.
Or, we were really calling the ball in mid 22.
Yes.
Right. That there was a problem brewing. People were, let's be honest about it, Joe. Most people were in complete denial until this time last year.
Yeah.
And then all of a sudden, most people that are invested in multifamily today, if you don't know there's a problem, you probably might want to notice the fact that your cash flow check from the syndicator had been cut off.
Yeah.
And it's a problem. And so we're watching it. We're not overemphasizing it this month. There are some things that we're watching, but I thought this trend line was worth noting. And the lending has cut off drastically.
Yes.
Lenders availability of capital in this area is very, very scarce, and way bigger skin in the game to get a loan. Call it close to 50% in most cases.
Yeah. Loan to value. Yep, for sure. So, and Eddie, call this one too. And this is high supply submarkets log deepest rent cuts in B and C. And, we kind of knew that, didn't we? When it was going to happen.
Well, I've only seen it for 6 cycles.
I know, right?
I mean, I'd love to tell you it was brilliance, but it's just gray hair on this one.
Yep,
right?
For sure.
The A buildings will get rented.
Yep.
They'll give away free rent, free cable, free parking, free whatever. They're gonna rent those new buildings.
Yes.
And I'll guarantee you it's gonna be like a vacuum cleaner on the B and C buildings.
That's it.
It's gonna happen.
Now,
are the A class buildings going to net the income they projected? Heck no. Because they gave away rent for free, and they gave away the stuff they thought they were going to sell. Yeah. But what it's going to cause is it's going to cause a lot of pressure and vacancy in the B and C class properties.
For sure. And that's just,
it's happened every cycle before. Why would this one be different?
Any different? That's it. All right, so here is the multifamily from Fannie, the economic market commentary, and this is for July of 2024. And this is the condo and apartment units completed and underway. The orange are the condos, which always is quite a bit less, and then the blue here is apartments. And Eddie, this goes out to the first quarter of 2025. I wanted to point, so we're not over here yet, nor are we, we haven't gone through
that tall line, Joe.
Yeah.
The tallest line on the page. That's where we are. Yeah, that one.
That's it.
And guess what? We've been calling the ball on this for a while.
Yep.
Now all of a sudden what you're saying, well, how come they're decreasing? Because they started reading too much inventory, and a lot of people ceased what they were doing with their construction. Yeah. Joe, there's all kind of people that if you notice right now, there was a piece of property and they bought it and it looked like they were fixing it. And then all of a sudden it's like, well, I don't know if they were going to build on it. They stopped. And so let me tell you something. That's an ugly number.
It is. And it's a lot of deliveries coming up there for sure. So there's a few markets, Eddie, where the actual deliveries or the new apartments coming online are actually going down. And, Houston is number one there. Year-end second quarter supply here, and then they're saying year over year that it'll drop down to 17,000, and there'll be at 8,000 apartments less coming online. That's still a lot of apartments to absorb right there.
Once again, this is people reading the market and pulling the plug literally last year.
Yep.
so that they were stopping them from going online this year.
Yeah.
Because there's really about a 2-year time frame from the time you start putting the promotion together to the time you finish it and it's on the market. There's about a 2-year time frame.
Well,
they started reading the market in 23 because the market in 23 started dropping like a rock. It dropped almost 20% in value.
Right.
So what you're seeing is what's coming on the market now was in 22 when everything was good.
Rocking and rolling, baby.
So, yeah. So there is definitely a fade in 25, thank God. And I'm not. Let me just say this: are we seeing a lot of capital flowing to the note space that was flowing into multifamily? Captain Obvious, yes, we are. Yes. Right? Yes. Are we wanting terrible for our friends in the apartment business? No, we're not. Whatever's going to happen is going to happen. The rate resets, the bank situation, which was 72% of all commercial loans, all of that stuff, Joe, I don't think any immediate market situation is not going to fix what's already set to happen.
That's it.
All right.
The factors weighing down multifamily rents and profit margins. So I thought this was well,
they've been watching NoteSchool TV, hadn't they, Joe?
Right. They're in the U.S. Second quarter. Just its rent growth can be minus 1% or 1% range, right?
Profit margins are less when the rents go down and expenses continue to go up. Expenses went up 50 to 60%, depending on the project, and rents went up about 20%. And now rents are on the slide. Yep. And so let me just tell you something. That's just less net profit. And this is we could have drawn all this with a crayon.
Absolutely.
Absolutely.
And this is the other part of that, and what is that, Eddie? 50 years? That's the highest seasonably adjusted.
I think I was in the 8th grade, Joe.
Yeah, well, I was in the 10th grade. Concession levels are now at the highest point since Moody started tracking this. It's been a while.
Oh gosh, but Joe, you should have just. I wish I could just take a snapshot of being at some events this time last year, and me saying, "Where are you worried about the trend in multifamily?" And people going like, "What are you talking about?
It's going to the moon."
And I'm like, "Hold on here, buddy."
Yeah.
Now I'm not saying everybody. I'm not saying that there weren't. I'm just saying there wasn't a general awareness. And there was an enthusiasm about multifamily that was kind of shocking this time last year. But by now, that's the case. Yeah. And if you have capital that you were putting in multifamily and you want to come on over here with the Note Boys, then that water's pretty good, Joe.
Yes, you're welcome, right? It's not 90 degrees.
Well,
right?
Let me tell you something. With the level of inventory we're seeing some fairly. It's okay to see more capital coming.
Yeah.
Yep.
So Eddie, multifamily properties values fall as insurance premium declines again, and our premiums climb. 6th largest expense in 2019 was insurance, and now it is the 2nd biggest contributor to their total expense growth. Was 8% of total expenses, and that number has jumped to 17%.
I know every operator that I know in the business today. Man, it is. I mean, and it's not just these expenses, but insurance, they are getting clobbered.
Yeah.
And Joe, I tell you right now, people are scared to file a claim.
Yeah. And that's the sad thing. That is the sad thing. And I'll tell you what, these condos that are having to do their 40-year inspection as far as retrofits right now, it's going to be a mess. They just had a big 1,000-unit condo thing that failed, and these people are thinking they're going to have to move out. And they may. Their balconies are starting to fall off.
Wow.
So multifamily delinquencies rise again. So you know, when we look at this, and we're over here, Eddie, they were, what are we in January? Well, let's see. In January of 24, we saw a spike go up there. Then what is this? This is right here, dropped a bit, and then now it's headed back up.
It's the more inventory that hits the market this year. There, you know, there was a lot of Kool-Aid being served by people that were in authoritative positions saying how much of a shortage of housing there was.
Yeah.
And there's some old people like me that were a little pessimistic about what they were saying.
Mm-hmm.
And I think we were right.
Yeah. Yep.
We didn't need 5 million new houses. I thought, like, who ran that math?
Yeah.
Right.
Yeah.
All right. Good. It is what it is. Let's talk about
NPLs.
Yes,
June
sir.
sees calendar-driven spike in delinquencies, but foreclosures remain historically low. Eddie, that's kind of let's call it a conundrum, right?
The inventory of delinquent notes are really old delinquent notes. Let me just summarize it. The inventory of delinquent notes are loans that are 3+ years delinquent.
Yeah.
Right. That's going to hit the market. It may be after the election before we see a surge. That's probably true.
Mm-hmm.
But it's got to be foreclosed on.
Yeah.
It's not going to fix. It's not going to fix. And it's got to be foreclosed on. And so, Joe, it is what it is. Underwriting has been tight for years.
Yeah.
So we're not seeing brand new loans that are defaulting at any kind of significant measurable rate because underwriting's been so tight.
Right.
Right. It's old inventory that just it's gonna drop off. It's got to hit the market.
Yeah. And, you know, again, this June, and Eddie, this could be the old joke, right? As far as in June, you know, there's 3 times a year you wouldn't get your payment, and that was in June because they had to go on vacation, then in August because they had to buy school clothes, and then December because they had to buy Christmas.
January is when they don't pay.
Yeah. Number of a single payment past due, highest since right at the start of the pandemic, and while 60-day delinquencies rose 11.8%, which is a 5-month high as well.
Look, it's Captain Obvious.
Yeah.
People, it's inflation. People have more month than they have money.
Mm-hmm.
To me, it's just Captain Obvious.
That's it. Well, here are the states with the most foreclosed homes, right? New York is number 1, numero uno.
Well, it only takes 5 years to foreclose up there. So.
Now, we learned something, Eddie, that not everywhere in New York does, but most of it, right?
It's the Northeast is not a shocker because of the foreclosure laws and how long it takes to foreclose. Michigan, to me, is quite a shocker.
Yeah.
Because Michigan and Ohio's market have really stabilized.
Yes.
But once again, if it's pin-up inventory of old loans, same thing in Texas, you know, same thing in Florida.
Yeah.
You know, it's pin-up inventory of old loans. These aren't really new loans that just got moved through the system as fast as they could. The majority of these are going to be loans with more than 1,000 days delinquent.
Well, yeah, and Eddie, even really some of that stuff back towards the end of, that 3 categories of legacy, you know, the real legacy loans back from 2007, 2008.
Before the virus.
Yep. And then right before the virus up until current, and then that mid-level loans. And that's what it is, for sure. So then we look at the states with the fewest foreclosures. Of course, Alaska's number 1 there with the fewest, and Montana is number 10. You could take every one of those states, and it really
probably take out. I'm going to offend somebody, and I don't mean to.
Yeah.
There's not a high population in those states.
Yeah, no, not at
Okay.
all. Alaska, Rhode
I don't
Island.
want to get them. I don't need any hate mail, so I'm not going to call them flyover states. But they're not a lot of population in those states. Those states do not represent a large percentage of the problem.
No. Nope.
But congratulations if you're in one of those states.
That's right.
Yes, sir. Okay, Joe, let's talk about overall delinquency.
Let's do it. So we are at 1.873. Eddie, we closed out the May-June with about 1.825 million.
50,000 mortgages more.
Yeah, 28,000 more. Yeah. So this is the number of properties that are 30 days or more past due, but not in foreclosure. And then you've got the number that are 90 days. And then the number of properties that are in pre-foreclosure, pre-sale inventory.
All right. So, Joe, we've got 431,000 loans that are severely delinquent, 90 days more delinquent.
Right.
And then add another 185,000, which are past that and into foreclosure.
Yep.
And now all of a sudden you get a number on the top side here, Joe. This is becoming fairly significant because you're looking at 650,000. You're looking at 650,000 loans that are headed for some degree of foreclosure. Not every loan. And another trend line is that we were about 200,000 loans that were being foreclosed on per year, right before the virus. And now all of a sudden we're looking at 186 that's in foreclosure right now. That doesn't encompass the whole year.
That's right.
So it's taken us a while to get here, but we're trending where we thought we would.
Right.
The big belief, Joe, is I'll repeat myself a little bit. The big belief is there is a surge coming in foreclosure after the election.
Right. Yes. Nobody wants that to happen.
I'm not saying it's political or anything. Okay.
Yeah.
I'm not saying that.
Yeah. And then again, we're still over 1,000 days as far as the average delinquency.
Loans that are delinquent headed for foreclosure, which is 215,000 loans, they are 1,014 days delinquent. I'm repeating that data because if that doesn't shock you, and you're just used to us saying it every month, because it's shocking to see that number.
It is.
One thing about our country, Joe, we'll react quickly on something.
Well, and again, just to put it into perspective, that's 354 houses. That's not people. That's almost 1 million people that are affected with the average, family of 4. So, we don't take that lightly when we talk.
No, we don't.
For sure.
But it's not. There's a point where they don't get better. It's not fine wine. It doesn't get better in time, right?
No, it doesn't. No, it sure doesn't. So, Eddie, we talk about these different cycles and just kind of run through these real quick as to why this matters, right?
Well, I mean, what worked in different cycles is very different from the other. And right now we're seeing a trend of seller financing. There's a trend of people seller financing their rental units at a rate we've never seen before, And that's because they can net way more income from renting than they can. Way more income from seller financing it than they can from renting. Like we're calling it 2.5 to 3 times more net income, literally. So that's why we're seeing it. And so, Joe, what worked in one cycle isn't in another. And I poke a little fun at some people in other industries because things were so good so long, they just act like it could never change.
Yeah. It's never going to stop, for sure.
Yeah. All right. So
Eddie, talk about this a second.
Well, I've said this many times, but I recently did a podcast and they put this in their their show notes of their podcast, because they were repeating something I said in the podcast, and that is it's better to do the right thing at the perfect time than doing the perfect thing in wrong time. Yeah. And there's some things right now that were perfect a couple of years ago, and it's just not the timing for them now. Yeah. Notes are better than multifamily and rentals. Sorry, I'm sure there's plenty of people who disagree with me, but we run the math every day in this business, and it's hard to deny the truth, because the truth is the income from apartments and rentals has waned down really, really low. And when you get a note, you get cash flow and you get money, and that makes a difference. And we're not saying that's a sales hook. It's just absolutely a market condition.
We do the math. We do the math. Eddie, we wanted to finish with this today, and this is the money market funds that are out there, as far as cash that is being held in money market funds by not just, these are individuals. And Eddie, that number is 6.440699 trillion with a T dollars.
Okay, well, let's look at the highest point before, which was 2008. Right here. And it was just under 4 trillion, and now it's 6.5 trillion. And the reason is people are struggling with what to invest their money in. This is exactly what the deal is. Mm-hmm. They were investing in real estate alternatives, rent houses and multifamily and other syndications. They were investing in the stock market. They were investing in other things. People are sitting on cash because those deals are not working. And I'm telling you with 100% confidence, they are showing up at Note School at a crazy, alarming rate. And that is because we have something to invest in that's different than the normal alternatives of real estate alternatives, which honestly were kind of our competitors, rent houses and multifamily. And so it's just math. It's not a shocker that we're seeing it. We hear it, Joe and I hear it every week in dealing with all of our Note School folks, and it just is what it is. But we are just simply saying, when we see these actions of people and then we do research, the data research affirms why we're seeing people reacting the way they're reacting. That's it. All right. Joe, great job.
All right. Well, guys, closing thoughts, Eddie.
Right thing, doing the right thing in perfect timing.
That's it. It's all about timing. Well, guys,
our business is going to be good when there's stress in other parts of the market, and it's going to be good when there's problems at the banks.
Well, that's it.
Yeah, it's 6 cycles. That's about the concluding thing that I've noticed the pattern over and over. And those things have come home to roost. And people may have thought, when we've been calling the ball so long, that we're a bunch of gray-haired old men that just want to get back to notes.
Yeah.
The answer is no. I think we were just calling the ball. We did good when real estate was going up in value, because we had real estate too.
Yeah.
But there's a time to hold and there's a time to sell. And I'll tell you what, I was in liquidation mode, to be honest with you.
Yeah, for sure. For sure. Well, guys, thanks so much. We appreciate you being on, and we will see you next week. Same place, same time. Take care.
Bye-bye.